BNB is one of the most widely used tokens in the crypto ecosystem, yet it often receives less long-term analysis than assets with smaller user bases. Launched in 2017 as an exchange utility token, BNB has evolved into the core asset of a sprawling ecosystem that includes one of the world's largest centralized exchanges, a high-activity smart contract blockchain, and multiple consumer-facing platforms. By January 2026, BNB remains among the most actively used digital assets, even as questions persist about regulatory exposure and structural dependence on Binance itself. Welcome to the Crypto IQ. Today, we're breaking down BNB's role inside the Binance ecosystem, examining the mechanics of BNB burns, assessing regulatory and governance risks, and analyzing whether exchange-based blockchains can remain durable infrastructure or whether dependence on a single corporate entity becomes a long-term constraint. BNB was originally issued as a utility token to provide trading fee discounts on Binance. Early adoption was driven by direct cost savings for traders. Over time, BNB's role expanded far beyond fee discounts. It became the primary settlement token across Binance services, and later the native asset of Binance Smart Chain, rebranded as BNB Chain. BNB Chain was designed to support smart contracts and decentralized applications with low fees and fast confirmation times. By 2025, it consistently ranked among the highest blockchains by daily active addresses and transaction count. Much of this activity came from decentralized exchanges, gaming applications, and consumer-facing protocols optimized for low-cost usage. BNB Chain operates using a delegated proof-of-stake model with a limited number of validators. This structure enables high throughput and low fees, but concentrates validation power among a small group of operators. Validators are selected based on stake and governance participation, with the active set remaining relatively small compared to permissionless networks. This design has supported strong performance. By late 2025, BNB Chain processed millions of transactions per day at minimal cost. It became a hub for retail-driven, decentralized finance, stablecoin transfers, and high-frequency consumer activity, particularly in regions with limited access to traditional financial services. However, the same structure raises centralization concerns. Validator concentration and governance influence remain closely tied to Binance's broader ecosystem, reinforcing the perception that BNB Chain functions more as managed infrastructure than as a fully decentralized network. BNB's demand is closely linked to its utility. It is used to pay trading fees on Binance, gas fees on BNB Chain, and participation fees across Binance-related services. This creates consistent baseline demand tied to platform usage, rather than speculative holding alone. BNB is also used in staking, liquidity provision, and token launches within the ecosystem. These use cases encourage users to hold BNB for functional reasons, differentiating it from assets that rely primarily on narrative-driven demand. At the same time, BNB's utility is inseparable from Binance's market position. Growth in BNB usage depends directly on Binance maintaining high trading volume, regulatory access, and user trust. BNB's supply dynamics are shaped by regular token burns. Binance committed to reducing BNB's total supply from its original issuance through quarterly and real-time burns. These burns are funded by a portion of Binance's revenues and on-chain activity metrics. By January 2026, a significant percentage of the original BNB supply has been permanently removed from circulation. The burn mechanism is transparent and formula-based, providing predictability around supply reduction. This has historically supported BNB's valuation during periods of strong ecosystem usage. However, burns do not operate independently of demand. Reduced supply can support price only if platform usage and revenue remain stable or grow. If Binance's activity declines, the effectiveness of burns diminishes. Regulatory risk is the defining uncertainty for BNB. Binance operates across multiple jurisdictions and has faced regulatory scrutiny in several major markets. By the mid-2020s, Binance restructured operations, adjusted compliance frameworks, and reduced exposure in certain regions to address regulatory pressure. BNB's close association with Binance amplifies this risk. Any restriction on Binance's services directly affects BNB's utility. Unlike neutral base layer assets, BNB does not benefit from broad institutional neutrality. Its success is tied to the fortunes of a single corporate ecosystem. This concentration cuts both ways. Binance's scale provides unmatched distribution and usage. At the same time, it creates a single point of failure that long-term investors must account for. Institutional interest in BNB remains cautious, while BNB is actively traded and widely used. It is rarely positioned as a core long-term holding in institutional portfolios. Asset managers often view BNB as an operational asset rather than a macro exposure. BNB is not typically framed as a store of value or a neutral settlement layer. Instead, it is treated as infrastructure tied to a specific platform. This limits its role in passive allocation strategies and long-duration investment theses. That said, BNB's consistent cash flow-like demand through fees and burns differentiates it from many speculative tokens. Its valuation is more closely tied to business performance than to abstract narratives. BNB represents a broader category of exchange-linked blockchains that emerged as crypto platforms sought tighter integration between centralized services and on-chain activity. These networks prioritize fast execution, low transaction costs, and simplified user experience over maximal decentralization. By January 2026, this model has demonstrated durability at scale, particularly among retail users who value speed, affordability, and direct access to applications without complex onboarding or high fees. Exchange-based chains like BNB Chain benefit from built-in distribution. Centralized exchanges provide immediate liquidity, wallet integration, fiat on-ramps, and user acquisition channels that independent blockchains often lack. This allows rapid deployment of decentralized applications and faster adoption cycles. As a result, BNB Chain has consistently ranked among the most active networks by transaction count and daily active addresses. However, this efficiency comes with trade-offs. Validator sets on exchange-linked chains remain relatively small, and governance influence is often concentrated among a limited group of stakeholders closely aligned with the exchange. The sustainability of the exchange blockchain model depends heavily on regulatory accommodation and continued user trust. If exchanges maintain compliance across key jurisdictions and retain access to banking and payment rails, chains like BNB Chain can continue operating as high-utility infrastructure. By January 2026, BNB occupies a unique position in crypto. It is deeply embedded in daily usage, supported by one of the largest platforms in the industry, and backed by predictable supply reduction. At the same time, it carries concentrated risk tied to regulation and corporate governance. Whether BNB is truly undervalued depends on how the next phase unfolds. If Binance maintains global relevance and regulatory access, BNB's role as infrastructure may strengthen. If pressure increases, dependence on a single ecosystem could cap its upside, BNB's future is less about narratives and more about execution, compliance, and sustained platform usage. That reality makes it one of the most distinctive assets heading into 2026. Subscribe to the Crypto IQ, as we will come back again with another interesting topic.